Most of the people who are buying assets at some point want to sell the assets at a profit.
Let me say it a different way.
Okay.
People that use fiat currency as a store of value, there's a name for them. We call them poor. Okay.
The silver flash crash appears to already be over just one day in, as the prices of silver absolutely explode as a result of the biblical demand for physical silver. Now, that is absolutely rattling the financial markets around the world, and with that, a swirl of rumors are coming into light, like bailouts, as Citigroup and B of A short millions of ounces of silver. Well, today we're going to talk about all those rumors. We're going to talk about whether or not the prices of silver are like 1980 and 2011. We're going to use math, and we're going to get to the bottom of what's going on with silver, starting with prices. As of the recording of this video, silver's up 10.12% or $7 so far for the day. The max it got so far was at $78.06. The market's not over yet, you guys. It's almost over, but that is a massive, massive jump in silver right after we had the price crash yesterday. Take a look at the gap. I posted this 6 hours ago. The silver flash crash didn't last long. Shanghai silver price in dollars was $80.64. So we got another gap that's trying to be filled. The scarcity of physical silver seems to be spreading across the world because the gap is even bigger when we look at Dubai that is selling physical. Remember, you guys, it's all about physical. It's not about the paper, it's about the physical. The price of physical silver is $95.05. That is a massive, massive gap. There appears to be a silver scarcity happening. When we go to SD Bullion, which is one of the most affordable silver companies, take a look at this, guys. They now have 6 different 10-ounce bars. Look at all of the ones, and this is in blue, that they don't have any longer. Now, I showed you guys yesterday that they were out of these 10-ounce bars right here. They now have them. I want you guys to pay attention to the price. So the first one right here for 10 ounces, the price 1 to 9 is $83.80 per ounce. Okay, so remember, $83.80. Now, when we go to 100 ounces, it drops down to $83.09. So you guys see what I'm talking about. Different denominations of silver and actually different styles of silver give you pricing windows. So remember, SD Bullion is selling 100-ounce bars at about $83.09. When we go to another popular silver dealer, which is Money Metals, look, it's actually higher, with 1 to 4 100-ounce bars selling for $84.93. So in other words, you're gonna wanna price out your silver and find these little windows. Remember, back in 1980, silver hit a peak, and then it plummeted downward, and it took several decades to get back to that peak. Same thing happened in 2011. Silver shot up parabolic, just like it's doing now, but then it crashed down, and it took another 15 years to hit that price target. So everyone wants to know, is the same thing that happened in 1980 and 2011 gonna happen right now in 2025 and in 2026? Mitch, can you explain to the viewers what makes today so much different than 1980 in 2011? And what I'm saying really is this: is it still safe to purchase silver, or are we just going to have a massive crash again that's going to take a couple decades to get back to that price? What's going on, my friend?
We are in a completely different world. This has literally zero to do with the Hunt Brothers crash in 1980. That was just them trying to corner the market. What is more important is to realize what the debt load is in 1980 as compared to where it is today. This is a totally different world. Then, over and above the debt load, is the creation of the derivatives. And the derivatives are paper chasing paper. And I've gone and made statements over time that this is going to be the unwinding of a lot of these problems, not having just specifically to do with gold or silver or metal, but the derivatives themselves, allegedly, globally, are around 600 trillion. This is paper chasing paper. And what you're seeing with regard to silver is the unwind of that paper chasing paper, because it is completely disconnected from anything having to do with physical. So as far as the charts that Travis was showing you, we're in a different world that's got nothing to do with that. This is pure greed, man-made, and it's on steroids. And now it's coming unwound.
Speaking of things coming unwound, I want to jump right into the rumors now, and let's talk about that. And at the conclusion of talking about those rumors, Mitch has a brand new form where he's going to use standard deviation to tell you guys the trajectory using math on the prices of silver. Starting with the facts, today, 12:30, there was an additional injection in the repo market. So yesterday, we had over 26 billion being injected. Today, we have $3 billion. You see that right here being injected in the repo markets. That's a form of quantitative easing. We have 2 billion in treasuries. Remember, they can lever those up. It's tier 1 capital, 33-1, and also $1 billion in mortgage-backed securities. Going into some of the rumors, here's an interesting one right here from Eric Yang saying, this is a sign of technical default by LBMA, sell-side members. ICBC, the Industrial Commercial Bank of China, is a LBMA member and a clearing member of the London Precious Metals Clearing Limited. The LBMA sell-side members are probably unable to fulfill their bilateral contract delivery obligations. So that's kind of scary if you got some orders out there. Here's another spicy rumor that appears to be mathematically impossible, which is basically institutional short selling positions. They're saying that Bank of America has $1 billion of ounces they're short. And Citibank is saying they're short. This is saying they're short 3.4 billion ounces, guys. 3.4 billion ounces of silver. We don't even make 1 billion ounces in 1 year. This article came out about 4 hours ago, and it's taking a lot of these rumors and kind of explaining what's really going on. This is saying 8 banks versus the silver squeeze as a $50 billion bailout rumor swirls. Official CFTC reports show banks collectively net short about 212 million ounces in COMEX silver futures as of December 2nd, 2025, across 22 banks, not 8. Remember, Mitch said yesterday, it's probably not just one bank, right? It's probably a whole bunch of banks, could be third-party risk. We don't know what's going on because they're not telling us the truth. Number 2, repo facilities surge near 25 to 26 billion. And remember, that's not counting today. That's an extra 3 on top of that when we count today. Point number 3, large short positions often reflect hedging, market making, and risk transfer, not bearish speculation or manipulation. Number 4, in silver, stress emerges through delivery and inventory constraints. The banks most frequently named in these viral threads, JP Morgan Chase, HSBC, BNP, UBS, Deutsche Bank, Citigroup, and Goldman Sachs. Reports suggest a major silver future player failed. We went over that last night. This is where everything started. Here's another fact. The Shanghai Gold Exchange, as of today, has raised their contract prices 20%. So it's going from RMB of 85,000 per lot to 120,000 per lot. So that is a fact. That is happening. And that did happen today. But you know what, guys? That wasn't enough to stop the demand. In order to really deep dive in these rumors, because clearly there's financial turmoil. The thing is we can't just name names because quite frankly, we don't know. Mitch has made this amazing workup right here. This is 5 pages. We're only going to go over part 1. And this is going to be followed by a standard deviation chart that essentially is kind of like, it's not, but it's kind of like a fortune teller using math and using volatility to tell us what is next for the prices of both gold and silver and really anything else. Mitch, my friend, the microphone is yours. Take as much time as you need to explain to the viewers what's going on.
Since I've been involved in these videos, I've been extraordinarily careful not to use any numbers that weren't quantifiable. And then silver hit. So now that silver is there and people are jumping up and down saying, what's this, what's that, what's this? The point that I want to get to was what I created in this document. So I called it proper analysis equals proper thought. So part 1 of this, and we're going to get through all of this today, but just bear with us for a minute. Why the deep dive into proper analysis? Gold and silver and the connection to the debt. That's the debt at all levels. And we're going to touch on that and exactly how bad that debt is. We're not here to make comments that are not backed up with quantitative analysis and mathematical probabilities. And we're about to dive in, and I'm going to show you what I do under the hood to get to the numbers that are quantifiable. We don't believe in hype. We believe in fact. Who is creating the volatility, and for what purpose are they creating the volatility when it shows up? And I said as long as a year ago, this is all about volatility. It's the study of volatility that drives the numbers. What is possible? The world's silver production is roughly 800 million ounces. What is probable? The demand seems to be outstripping supply. You have industrial demand plus now FOMO, fear of missing out. What's driving that FOMO? A lot of this nonsense online. Paper chasing paper. That's short without the ability to purchase the physical, and short paper contracts not backed by the physical, which by definition is leverage upon leverage, and then add third-party counter risk to that leverage, which is more leverage upon leverage. Ex-banks, and we're saying ex-banks because there's no evidence of what banks are involved in this at this time. So ex-banks were short gold and silver contracts. That's true. There is no way to know specifically because the damage on the silver pricing was done within the last 20 days. And as such, does not appear in the income statements or the balance sheets of any of the major banks that Travis had outlined previously. In addition, you may have what's called off-balance sheet financing and off-balance sheet contracts, which are not easily trackable. Over and above that, they don't want it trackable because that would lead to the third-party credit risk. Who is the credit default swaps? Who's supplying them? What's really going on there? So the third-party credit and counter risk, such as the credit default swaps, the reinsurers, and the participating banks, who are they? Does the Fed even know who they are? Or like I said the other day on Sunday night, the Fed is going to be in a meeting at that time, and they were. Doesn't mean that they know who the third-party counter risk is. They could be looking at this globally and saying, we will plug whatever hole shows up. What you are looking at is not just short positions. The notional value of gold futures is calculated by multiplying the contract size, which is typically 100 troy ounces, by the current market value of gold. For example, if gold is trading at 43.83 per ounce, the notional value of the futures contract is 438,000 per contract. If you have 50,000 contracts, you have 308 billion. That's the leverage upon leverage. The margin cost that people have been yipping and yapping about is going up X dollars based on the volatility. The brokers have a formula. Volatility goes up, so do the margin costs. Supply issues add complexity for which the brokers will not take the risk, thus increasing the margin in excess of 1%. Margin is leverage. So margin is leverage divided by the gold dollar notional value, divided by 100 troy ounces. That's your leverage. That's the true leverage. Add to that the physical is hard to source and slow to deliver. That is true, and people are seeing that play out, and that's what Travis was just showing you in SD bullion. The damage of those who participated in the shorts may be irretrievable, but for the Federal Reserve stepping in to stop the vortex of participants stemming from the banks into the third-party counter risk providers and stop the implosion of all these bad positions. Should the Fed step in? No, my humble opinion. Will the Fed step in on behalf of the US Treasury? Probably. Eventually, the truth of all this damage will surface. Gold-silver production is effectively capped at 800 million ounces per year. The paper-chasing paper ounces short, how much of that paper is to be determined. We don't know, and we don't have access to such data, including the commitment of traders. All this nonsense online is just that. It's spin. People are taking positions not backed in quantitative analysis. Whatever the shortage of paper chasing paper in the particular bullion banks, i.e. 4.4 billion ounces, to cover these positions, be it the 308 billion notional as of today, these banks would need to contract purchase every single ounce of silver mined out of the ground for the next 5 years, never mind what the real demand and uses exist today. So you have solar, batteries, EV cars, all of which take up to roughly 60% of the existing production right now today. In other words, the existing physical demand is just a very small component of the paper chasing paper. And that paper chasing paper is the crux of the problem. It was never real to begin with. The free flow of investment grade silver is extremely small, same for platinum. How is this even allowed? Well, you have unallocated silver accounts and rehypothecation. The bullion banks have likely leased the same physical bar of silver, 10, 20, or maybe even 50 different clients have it. They've leased it out. Does that not sound like Tricolor, the auto company that just went bankrupt, who had multiple loans on every single car? This is not force majeure. Force majeure is an act of God. This is 100% purely man-made greed and manipulation on steroids. Will the LBMA survive? Well, to be determined. Is there a need for a clearinghouse like the LBMA to clear paper, chasing paper? No. Is there a need for a clearinghouse to do cash settlement as necessary on metals? Yes. Last point of part one is if you don't own it and it's not in your possession, you don't control it.
I want to go into a couple more rumors and a couple more facts real quick, and then we're going to go over Mitch's special fortune teller, or rather mathematical formula to tell us the trajectory of prices. But first, take a look at this. Here's a very interesting rumor that just started circulating, that is Donald Trump to ban export of silver from USA by January 1st. The supply shock is coming. Olivia07 on Twitter continues, unconfirmed reports suggest Donald Trump may push for a U.S. silver export ban as early as January 1st. If this happens, global silver supply tightens instantly. Availability inventory is already near critical levels. Industrial demand stays strong. Monetary demand isn't slowing. A supply shock this late in the cycle wouldn't be minor. It would be explosive. Here's something else that's not a rumor. President Donald Trump orders Section 232 investigation on critical minerals and derivative products. Now, this was in April of this year. Now, as a result of this investigation, Trump added 10 minerals to that list back in November. Anyone want to guess what that is? This article came out, again, November 7th. Trump adds copper, other minerals to the USGS critical minerals list. But when we scroll down here, and I highlighted that, part of that was silver. So that is a fact, and that happened about a month and a half ago. Now, I'm not saying they're going to restrict silver because there's some fake war being lodged against Venezuela. I am not saying that, but that is an interesting theory. This came out late yesterday. Trump says U.S. hit dock in Venezuela, marking first known land attack. That's interesting. This morning at about 4:30 a.m. in the morning when I was up, President Trump warns that many surprises may be coming in the next 48 hours. Samsung silver solid-state battery technology requires 1 kilogram of silver per car. And look at some of these stats. Let me scroll down here. This battery is incredible, you guys. It has a 600-mile range and has a full charge in 9 minutes. It's lighter weight and has a lifespan of 20 years. Whatever this new battery is, it's something special. Before going into your forecasting sheet, do you think there's any truth to these rumors? Do you think that there's going to be a ban from exports in the U.S. in silver January 1st? Or do you think that's more hogwash?
With regard to Samsung, show me the battery, because until I can see it, I'm not talking. It's about the same issue. It's got to be quantifiable. Rumors and print and nice pictures don't cut it. I think they've got something. I believe they do. That's just a personal opinion. But would I state my life on it? No. I want to see the battery, prove it. With regard to this idea of critical metals, critical materials, I get it. I have no problem with it. If it's critical for U.S. national defense or any other country's national defense, they should be doing the same thing. The problem that I have is that silver, gold, platinum are all minerals. De facto, if you control the export of the minerals, and those minerals are currency, which they are real money, then how exactly is that not currency control? Did anybody bother to think this through and bifurcate out what is truly critical minerals as compared to critical metal? Did they bifurcate it out and say, X, we're not going to stop currency. We're just going to go after what it is that we need and block that up? So far, haven't heard anything about that either. So I believe that, yeah, they absolutely want to control it. My point is, are you really going to try and control currency? And this ties in to what it is we were talking about the other day globally. Whether these countries realize it or not, they are going to have to get along. And part two of what we're going to get into after I go through these spreadsheets is going to explain why they must get along, because the alternative is horrific. We're going to go through two spreadsheets, but I want to double back and explain the sheet that we had on a prior video. This is now the live sheet rather than a screenshot. So what had happened, the spot rate, if people were buying contracts on spot, which is the futures of 45.25, and the value dropped 4,025. This is on gold. and the volatility was 12.71%. Remember what I've been hammering on. This is all about volatility. It's the measurement of volatility. And then the interest rate is what they consider risk-free interest at 4.25, which matches US Treasuries. Well, if we had this, as I did on the original screenshot, out at 45 days, the loss in value to those who held puts, anybody that bought a put, unilateral direction, weren't hedging, just straight up bought a put, we're short the market, end of story, they lost 590% of their value. If the volatility goes up, that loss is magnified. If they bought this, say 60 days ago, not 45 days ago on the options expiry, but prior to that, then they would have lost even more money. That's the point that I wanted to make by allowing you to go through this with me. And all of these values would end up changing dramatically. Then somebody asked, well, what was the exposure in terms of how much money could gold really go to? Well, allegedly, the US holdings in Fort Knox are 261 million ounces. US gold holdings, based on that ounces in today's money, right, today's value, is 1,181 billion. The US national debt, just by itself, not including the outstanding school district bond debt or anything else, just US federal national debt, 38 trillion for the sake of conversation. If you say that we want gold holdings to be the equivalent of that US national debt at 38 trillion, that's 15,200 billion, okay? So what does that mean? If you take that amount, the 15 trillion, and you divide it by the 12.8, which is 1.18 trillion, you end up with a value at 58,237 per ounce of gold. That's where it could go. 40% of the 127 trillion, you end up with another 50 billion on top of that. The point of the matter is, if you do all that and you combine it, you can get the idea of where this goes. That 50 trillion will end up turning into in excess, well in excess of 80,000 per ounce. We have no idea what the government is going to do, how they're going to establish this value. We know for sure that the BRICS, the unit, is depending on the American government to determine what it is they're going to peg the metals to. Could that be gold by itself, or could that be silver by itself? Either way, it's clear. We've got to head back to a gold standard. And what we're going to show you in part 2 is that that gold standard needs to be across the globe to prohibit and ensure that there's no more wars like what happened in Germany. Over and above that, just for the sake of conversation, those banks, alleged banks that are in trouble, if there were 50,000 contracts, they'd be out right now short, loss, over $20 billion. All these things tie, and now we're going to go into the next spreadsheet, and then we'll come back to part 2. I'm going to walk you through a spreadsheet that I use. Now, I have one just like this. It's also for gold. I have dozens of these things. This one specifically is for silver because of the volatility in silver. So over here, you will see that the volatility days that this particular spreadsheet calculates is based on the last 21 days. We have 252 trading days out of the year. The current close is $70.46. The current volatility, because silver has been extraordinarily volatile, is 60.70%. The average volatility is 30.76%. The maximum volatility is what we just hit at 60.70%. The minimum volatility this year out of the last 252 days is 15.28%. Well, if we take the open, high, low, close, that's what these numbers are right here, and we take it for the last 252 days, and you go down, we're just tracking it, then we bring that over and we say, okay, fine, here's those values, open, high, low, close. What happened to the price change yesterday? Down 9.13%. Annualized volatility, because it was such a large move, went up. The daily volatility was down between the last 2 days. The speed, different unit of measurement, then you have a term structure, the variance squared, and you start seeing where all this is headed. So I can tell you up here very specifically, how many days this year, every day, where volatility went up 1%, greater than 2%, greater than 3%, less than minus 0.5%. We can tabulate all these things. We know what the volatility is driving in terms of price. So as we go through all this machination, we get down to right here. Point being, if I know all this, then why doesn't the Federal Reserve and those people that were allegedly trading, such as the banks, know all this? They've got, in the case of the Federal Reserve, 23,000 employees. So our high was 77, our low was 29. This is out of this year. The difference of the high to low, 47.97. The average was $40.23. The current volatility as versus the average was 29.9. The change in volatility from high to low is 62.14. The point of the matter is, I know what the difference is. 14 days, 8 days, 1 day. We can tabulate the standard deviation at 2.21%. The variance, square that by 252 days, gives you an annualized variance of 12.23%, while the annualized standard deviation is 35.04 based on these calculations, which includes the volatility. Okay, if we know all that, how do we extrapolate that forward and figure out what the real pricing is going to be, plus or minus? Well, here it is right here. If you know what your standard deviation calculations are, one standard deviation move means lower, one standard deviation, you will drop by minus 1.87%. Your upper range will mean you will go up 2.54%. That proves the positive drift that's natural to stocks and to metals, especially at this time.
Let me just make sure I got this. On row 313, it says upper price 75.36. That's 3 standard deviations. The price right now hit close to 78. Does that mean today that the standard deviation on the move of silver is above 3?
I believe it is.
That's massive.
Yeah. And that's what this is showing, right? So if you have a 3 standard deviation move, it's a 6.96% move. That would be the equivalent of $4.90 move. And I think we're above that, just to give you an idea. So I have this dialed in on a half standard deviation, 1 standard, 1.5, 2, 2.5, and 3. Here's the lower percent. Here's the upper move as a percent. Here's the lower dollars that it would go down 0.54 up to down 4.43, or up $1.01 to up $4.90. The point being, here's your pricing right here. And I'm not sure where we are at this exact second, but your lower price on a 1 standard deviation move today would have been $69.14. Your upper price would have been $72.25. If we hit 74 or 75, that would be the equivalent of a 3 standard deviation move.
This is perfect for where we're at in this segment. But if today the price of silver went up in price past 3 standard deviations in the face of multiple margin increases, so we have multiple margin increases from the CME and then from Shanghai today, what does that mean about the demand of silver?
We don't want to conflate 2 different issues here. So realize what happened yesterday, and I have a chart that'll show you that in 2 seconds. We had an outside bear bar, and all that is happening today is you have an inside bar. Nobody knows specifically from a trading perspective whether this will inside bar continue up or it will reverse. Outside bear bars typically are followed by a doubling of the height of the outside bear bar from a technical perspective. Doesn't mean it's going to happen, right? Flip side of the coin is if you've got an outside bear bar and this today closes positive and tomorrow closes positive, there's a high probability that that outside bear bar is a complete fake out and it will double the height of that outside bear bar.
Absolutely incredible, because normally, just for the viewers, and so we're all on the same page, when they lift the margin requirements, generally that puts heavy downward pressure on prices, not heavy upward pressure to prices like we see today. Is that correct, Mitch?
Yeah, you have 2 issues there as well. So one of which is the margin cost. Why is margin going up? Because the brokers themselves, the tasty trades of the world, don't want to take excess risk on their margins that they're holding. But over and above that, you have commissions, or what they call premiums. So the premiums start bopping up and down based on the holding cost of the broker that has the metals and how much they're holding. So
Yeah.
all of these things are at play.
And I don't want to speculate, but just looking at the math, understanding the margin increases, and I know we need another day of this, another day or so, we need to keep going, but it appears that it's off the chart. The demand for physical silver is off the charts. This chart doesn't even pick up the $77. You only went to 3 standard deviation because that's how much you should go. But it broke through that, shattered through that in the face of double days of margin increases.
And you can see the demand from places such as Dubai or India. When you look at their physical demand on their charts, on their stock markets, on their exchanges, they're $15 higher than the US. You quantifying it to US dollars, apples to apples.
And is that how they got Hunt Brothers to collapse? Did they just raise margin requirements, or what happened as it pertains to what's happening now in relation to Hunt Brothers in 1980?
No, Hunt Brothers was nothing more than they got squeezed out. They tried to corner the market, and then the participants came back in and squeezed them and busted their trade. In those days, you could do that because the options and the trading itself was extraordinarily thin. It just wasn't that big. So they just figured, okay, fine, it's us with our cash versus our physical holdings. We'll break everybody in sight, except, yeah, it didn't work. Here you can see the outside bear bar, how big it is right here in comparison to all the other trades. And within the last 20 days, this is where everybody got hurt because it kept going. First leg up, pull back. Second leg up, pull back. Third leg up, way up here, pull back. So right now we're trading inside of that bar, which means if you're a trader, you're in no man's land if you're smart. You know, you can trade it intraday, and I'm going to show you something here. So from an intraday perspective, based on the volatility, right, when you have the expected move, see this expected move as a percent of the underlying? This is a 45-day window. I'm looking out 45 days as to where the pricing is going, and I'm seeing what the probability of the closing below the target, which is the upper target. So I'm looking at all these probabilities and stacking all the probabilities. Well, here's what I want to show you. On a daily basis, here's your upper. This is 1 standard deviation. Here's your lower. If you're trading options and you're anywhere in the middle, so if you sell a call above this blue line and you sell a put, which is a strangle below the red line, you don't care where the price goes as long as it stays in the middle and volatility doesn't spike up. You're good. So right now, somebody was selling based on this, and they said, okay, fine, I'm going to do a strangle and I'm going to collect my theta. I can get my money up front. And in 15 or 21 days from today, you buy it back. You've made pretty good money because the volatility is so high. It makes the premium on the options expensive and allows you to collect your theta decay. But I want to take it one more step. We can actually break this down, not just by the day, by the week, by the month, by the year, which I have all of those over here in this column here on the day math, but we can do it by the hour. Here's 15 days, 30 days, 252 days. You can expect the price of silver up or down, minus 42, up 41. That's the bracket I just showed you.
So last question before we move on to the final, Mitch, is what's the highest probability that prices of silver will keep going up? What probability is that?
Well, okay, you pick a time frame. You want to go 7 days?
Yeah, let's do 7 days. Tell me the probability in 7 days, what's going to happen to the price of silver.
You have an 88% probability that in 7 days, silver will be below its upper range at 88. That's in 7 days. With regard to part 2 and how all this ties together, what are the issues and volatility shown in the spreadsheets telling us? We know that there's $23 trillion worth of property scam, and there's a video link, and we'll put this document below this video. The current system of school district bond issuance in Texas bears a striking resemblance to the MEO bills and economic fraud of the 1930s in Germany. Both systems rely on artificial value creation to sustain government spending that the real economy cannot afford. Here's how they match. Artificial value to back the debt. The MEO bills, the German regime created MEO bills, promissory notes, with no real gold or currency backing to fund massive military rearmament. They essentially invented money out of thin air to pay for projects they couldn't afford. The Texas school boards use appraisal fraud, which creates fraudulent school district bonds, which accomplishes the exact same thing of creating false value, no different than the German regime. By artificially inflating property values, sometimes by 30% or more in a single year, despite low inflation, the school districts create a higher tax base on paper. This higher paper value allows them to issue massive new bonds that the actual incomes of the residents cannot support. Just like the paper chasing paper in the silver market, the majority of paper has no value as its ability to make good based on the physical does not exist, meaning the extreme over leverage is not backed by assets. What do we have? We have a ticking clock of debt. The MEO bills, by 1939, those bills were coming due. Germany had no real money to pay them, making the conquest and the seizure of foreign resources the only way to avoid domestic collapse. The Texas school bonds, those bonds are issuing new bonds just to pay off the interest on the old bonds. Starting to see a theme here? This creates a Ponzi scheme dynamic where the debt grows exponentially. Godly Texas, where the bond debt per household is roughly $120,000, while the average home value is only $160,000, meaning the debt is nearly equal to the total asset value. Concealment and noble causes. The MEO bills, they were hidden from the public and international observers to maintain the illusion of an economic miracle. Germany was growing and Germany was prosperous while secretly preparing for war. The Texas school bonds, the point being that the noblest causes, we're doing this for the children, are used as propaganda to mask what I have shown as accounting fraud and bond fraud. The school superintendents and chief appraisers work together to set predetermined budgets and then manipulate the effective age and property cards to meet those numbers. The threat of total collapse. Just as the MEO bill fraud made in World War II an inevitable necessity to avoid Germany's bankruptcy, we have 5.1 trillion worth of bond debt, school district, nationwide. It's a ticking time bomb. If the controlled demolition of this system, which is repealing the property tax, doesn't happen, it will lead to a crisis in confidence and a financial crash worse than the 2008 housing bubble. The key stats are pretty important, and we've hit on these a couple of times. We estimate that we have 21.25 trillion worth of property overvaluation. This has occurred in the last 5 years alone, from which in 2024, 450 billion roughly in overtaxation. Money was stolen from the homeowners. In some Texas districts, taxpayers are on the hook for repayment that are many times the original amount borrowed. As a further example, and you're seeing this play out, and Travis showed you that the other day with the pictures of the tractors in London. As a further example, the European Union, United Kingdom, Ukraine, Germany, Minneapolis, Minnesota, Conroe, Texas, all did the exact same thing that the MEO bills did in Germany, which is to create money or debt, which is the cause of the problem, fraudulent bonds that leads to both institutionalized systemic moral hazard and the symptoms of property tax lien foreclosures, bankruptcy, and or losing the roof over their head of roughly 37.8% of the households, which is roughly 42 million households. And in the case of the countries mentioned, they march toward war, all to cover up their fraud, just like Germany did in 1939. The school boards use inflated appraisals and equity strip property owners in terms of paying down their mortgage and place future debts upon the property owners from which there is no revenue to be obtained to continue the fraud, making property owners economic slaves to the debt created by criminals. And as we have filed with the DOJ, the FBI, and the SEC, this all ends in RICO, if not worse. No school district should ever be allowed access to the bond market and use property values from which to gain tax revenue. The school district's credit card must be canceled. Perpetual tax debt equals debt slavery. Institutionalized systemic moral hazard ends when the school districts no longer have access to the property valuation fraud by the central appraisal districts. Repeal all property tax in favor of the uniform states sales tax. On my website, there's a link. You'll just look it up. It's called benefits. Put the word in there, and it'll show you what the benefits are of repealing all property tax. They stole your money to transfer that wealth to those who did not earn it, and that is the definition of socialism. Socialism ends when you run out of other people's money, and that is now, because the median household income does not exist to pay for the fraudulent debt. Demand from your politicians the termination of the school district's credit card. We have learned, what we have shown you here today, that there is a direct correlation to the property tax fraud, silver scam, and printing of money via the US Treasury and the Federal Reserve. The nexus is the creation of false value, being fraudulent property valuation from which to steal tax revenue, fraudulent paper chasing paper from which there is no physical to back up that paper, and fraudulent printing of money, which causes inflation, which is a hidden tax. This is the reason why every person watching this video must be active to make the politicians aware and then push them into admitting the necessity of controlled demolition before the politicians push the world into meaningless and unnecessary wars. Your life and your children's lives depend on your involvement.
Now, if you've been following along with us, you know how important it is for Mitch and I to abolish property taxes, or repeal property taxes is the legal term, and wake up mom and pop to the atrocities and the debauchery that's been happening for the last several decades at least. Now, don't forget, you guys, we both have unique websites designed to help mom and pop. The first one being Mitch's website, which is right here, you guys. This is Mockingbird Property. So this has all of the evidence. This has all of the math. If you go to the DCAD right there, you can get the information, including the bill to repeal property taxes as well. And that bill has all of the math on how to abolish property taxes. We don't have to guess. The math is there. Now, when you're done with that, my site is more of an advocacy site that is designed to create teachers, patriot teachers. And those teachers, I'm hoping, are going to also teach mom and pop with what we've learned here today. Now, I have home buying, I have property tax protest, I have abolishing property taxes, and what I'm working on right now, you guys, with your help, and I really appreciate each and every one of you who has reached out and helped us to create this advocacy. But what I'm working on right now is how to deal with boards, councils, and bonds. So I'm going to have a step-by-step on how to do that. I'm also going to teach you guys how to be investigative journalists, because we need more of you guys on the street to expose what's happening underneath the covers, because ain't no one going to tell us the truth. I really appreciate you following along. This is a little bit longer today. Let us know how we did below. Don't forget to go to the links, email us, let us know what's going on. And if you guys are out there just trying to figure out what's happening with silver or the housing market or the economy, whatever it may be, you guys already know we wish you luck, and we hope you win.